think one of we're talking a lot about the stories, and I think one of the important pieces of the story that often gets overlooked is the importance of the historical financials. So the historical financials tell a really important part of how you got to where you're at. And oftentimes when we get engaged, it's because people have overlooked. They're ready to tell their story, but they don't have the financial numbers to present. So really understanding that you need the numbers as part of your story to help tell the story of your business, and really to ensure that the story your numbers are telling are aligning with your narrative. If you're telling a story of sales growing up to the right and your financials don't show that, then there's a disconnect there that's going to, it's going to unsettle potential users of the financial information. So really making sure you've got good historical numbers, you're presenting them well, and that they're aligning with the narrative of your business is really important. So Rob or Chris, no? Okay. So just a quick shot on some of those financials in terms of what investors want to see. I mean, I'd say at a minimum, investors are generally looking for trended monthly financials for a period of time, generally at least the current year and the prior year at a minimum. Some investors will ask for more information, and trended financials are really important because numbers in themselves don't really tell you much. They tell you more when they're compared to something else. So when you start comparing your financial results month after month after month, you can really see the direction your business is going and better understand kind of that underlying financial story. The other thing I think that often is a challenge for a lot of people is GAAP is really preferable to cash. So a lot of companies start out early on doing cash accounting. That's understandable because at times, there's times in a business when cash really is kind of the most important thing you're measuring. But as your business grows, GAAP becomes more important because GAAP really tells the story better through trends. And so kind of as the two graphs to the right show, if you're telling a story of revenue up and to the right growth, and you're using GAAP accounting, you get more of that trend line that demonstrates that. When you start using when you're using cash accounting, because of the lumpiness of it, it's often hard then to see the real true story of how revenue is growing and maturing. It's also easier for investors to pick up a set of financials that are prepared on a GAAP basis and really begin to understand what the cash needs of the business might be, what the burn rate is. So they're just able to get kind of a deeper understanding of your financials through GAAP financials. The other thing is it's really important that you have historical SaaS metrics for the same period as your financials. And admittedly, early on, the metrics may not look great, but as your business matures and you start getting traction, then you can really, again, see the maturity of the business and the growth of the business through the trend in your SaaS metrics. And finally, I think that the big area of always investing in SaaS companies, right, is what's the revenue look like? And more importantly, who are the customers? How are the customers maturing? All of that. So really being able to present really good, detailed, trended information by customers, whether it's by sales channel, by recurring revenue, non-recurring. So having that underlying support and detail for your revenue on a customer basis is often really important for investors.
I have once heard that when you go about a fundraising, basically an investor is looking for time and reasons to say no, right? And so every opportunity you give an investor and acquirer an opportunity to say no, you've limited your options, right? And so this is so important is the minute you enter the friction of cash accounting, it trims off one of the, it's like, I can't, like say it's September 20, look at that cash account. This is the same, by the way. And so you see the September 20 is like, oh, I don't know what's going on. You're shrinking when really you're not. And it just adds friction and makes it that much easier to say no. So I love what Kari just said, echo it wholeheartedly.
Absolutely. And the only thing I would add too, guys, is somebody was asking about the bands and what we presented and the current market dynamics. I think what we're seeing in the current market is a lot of companies raising or publicizing that it's a Series A or later even because they've bootstrapped or skipped some of these steps. So you'd be surprised. I mean, we're seeing a lot of velocity of businesses that are raising significant amounts of money that don't have the back office kind of financials ironed out. And so I think it's just indicative of the level of financial operations maturity of these stages of businesses. So, if you've raised a seed round or you're in the Series A, these are things that you certainly need to take away. And I think Kari's next slide, if you're at a later stage, really kind of takes these points home for the takeaways for that crowd.
And, and actually to Rob's point, investors looking for a chance to say no, they're also looking for a chance to pay you less, right? So, don't give them excuses, right? So when we talk about, financial presentation, this is an example of kind of a SaaS P&L, which I think is a really important piece. And so one of the things to focus on is when you're presenting these financials is you want investors from the surface of your financials to get a potentially pretty good understanding of your business. And so presenting that information in a way that allows them to understand, for example, your revenue. We'll see a lot of P&Ls that just lump everything into one revenue line. Well, it doesn't help an investor to know, well, is that recurring revenue? Because that's what they really want to understand, right? In a SaaS business is what your recurring revenue is looking like. How much of that is professional services? If you have different channels, for example, I have a client that sells both into the enterprise market as well as to smaller kind of SMB market on a month-to-month basis. Investors want to understand that. How much of that is that enterprise business? How much of that is that month-to-month kind of business where subscribers are deciding on a regular basis whether to re-engage with you or not? The other thing is to help them understand your spend. We'll see a lot of P&Ls that will list spending by how you're spending. I'm spending it on salaries, on benefits, on rent. All of that is important. But at the end of the day, it doesn't give the investor the sense of where you're investing in the business. So really categorizing your costs and presenting them on your P&L that really helps them understand how much am I spending on customer success, for example, and does that does that align with your revenue growth? How much are you spending on continuing to spend on product development? How much have you been spending on sales and marketing? These are all key things for an investor to understand, because as they also look future, they're kind of trying to understand where you might need to be making additional investments in order to really fuel the growth of your business. And then I think finally is margin's important for SaaS businesses. There's an expectation that SaaS businesses are turning out pretty high margins. So make sure that you're classifying your costs well between cost of sales and your cost of sales and your operating expenses. So, but focus on what's significant and what will move the dial. So if you have a customer success organization that, for example, is on occasion supporting sales and marketing, but not on a regular basis, probably not worth a lot of effort to kind of split those costs out because they're probably not significant, won't change anybody's mind about your financials. But if you have a customer success organization that's splitting like 50% of their time supporting your existing customers and 50% of the time supporting your sales and marketing effort, it's probably worth splitting those costs out, moving the portion that's related to sales and marketing out of margin and down into your OpEx. So again, this is really about presenting the information in a way that an investor can kind of stand back and get a good sense of where your business has been, just from the surface of the financial statement.
Yeah, this is great. On the point about margins, notice that there's actually more accounts, more line items for cost of goods than there is for operating expenses, right? That's almost more important as long as it's categorized correctly. So,
yeah, and I'm taking a quick look at some of the questions that are coming in. So I want to just kind of address a couple caveats here. We have a broad audience. So, like in all of the presentations of the metrics and the financials, you really have to determine what's in the best fit of your industry and your business model. There might be things that we're showing here on the chart of accounts that aren't as applicable to your business or not, but really, as Kari was articulating, split it out where it's appropriate. And one of the things that we see really often is people cite, the gross margin or cost of goods is referred to here. You also will see it presented as cost of revenue. Footnote where you can, if you're going through a deck and you're presenting these numbers of how you're breaking it out. This is the best practice to have it in your financials and have that detail shown. Astute investor that makes it to the diligence phase will certainly pick up on that. But also, make sure that you're kind of footnoting the presentation of how you're defining these. Because as the questions are coming in, there are a few ways of categorizing cost of revenue. Internal engineering, it really depends on the SaaS product that you sell or reoccurring product that you sell and whether you would include that or not include it, et cetera. So all really good questions. The other thing I would expand on too is Kari, this is a phenomenal example. And if you're already doing this, great. The next iteration of it is being able to project these out and showing, how are you going to deploy the capital, and it should flow into this. So you get into a lot of the FP&A modeling of okay, if we invest this capital, how are you going to use it, and how is that going to flow through into the financials? So if you're at the stage where you're already tracking these, start working on the modeling and have a best-in-class model that kind of shows and supports the capital raise that you're looking to do.